Okay, good morning, everyone. Thanks so much for your time. So, this first, a few things I want to clarify. Like I mentioned last Wednesday, so I create this bonus point um, opportunity for you. So whenever you participate for the events, I send you by email, and you should be able to earn those credits. I got several emails from the students. So here's answer the questions all together. So just please wait until all the events finish. For now, just please make sure you make notes. If for some reason you for some reason so you lost your notes, you probably want to ask me an email to find out the slides. All right. Okay, this is the first thing. The other thing is, so we are going to have a pop quiz today. So I'm going to open the pop quiz later. Okay. All right. Okay. So now let's back to our new material. So last week on Monday we have exam, and Wednesday we talk about a overview of macroeconomics, as I mentioned on Wednesday. So that overview just gives you a quick introduction of what's macroeconomics. And then starting from today, so we are going to dive into the details. So essentially the details we kind of skipped on Wednesday, right? So the first chapter we are going to discuss is national income account. And here's a roadmap of this chapter, right? And so basically, in this chapter, we are trying to understand how we measure or how we keep track of the performance of the economy. Okay? And then so we are going to rely on GDP or gross domestic product. I'm going to explain to you there are three different ways to calculate GDP, and they are equivalent, or in other words, they are going to give you the same number. And then next, we are going to look at the difference between real GDP and a nominal GDP. We want to understand why we want differentiate between real GDP and the nominal GDP. And finally, we look at price indexes, or how we measure an aggregate price. So this is a roadmap. Now let's start with the big questions. How do you measure an economy? Right. So like this background picture shows, a typical economy has so many different business, so many different economic activities, right? So how we can measure an economy, and why this is relevant. And think about in the newspaper, right? So the newspaper say this is like 2010. China passes Japan as second largest economy. But that's how we compare China versus Japan, right? Or another example. So if you read news recently, and they say, oh, so the COVID-19 hit most economy hard. In the United States, the second quarter, like Q2, the economy declined by over 30%. What does that mean? How we come up with a number of 30% decline in the second quarter of the United States? Right? So that's the main topic of this chapter. So essentially, when we compare country A versus country B, economy A versus economy B, or when we look at US economy in the first quarter, second quarter, third quarter, we do the comparison. Basically, we are comparing the value of their production. Okay? If we just look at the value of their production so that we have a measurement of the economy. And here we are going to rely on GDP, which is gross domestic product. The GDP becomes the most important and common way to estimate an economy's size. Okay, so this is GDP. For the GDP, we rely on the national accounts. So the national accounts stands for the national income and the product account. So there are two keywords, income and the product, short for Nipa. Right. So this Nipa account is going to be used to measuring our nation's economic performance. Right? So, but apparently this can be used to measuring not only the nation, it can also use to measuring the state, the city, right? And then so we can use this Nipa account to comparing American income and output to that of other nations. Again, so you can compare in one city versus the other city. Also, you can compare in the city's performance of this year versus the past year. And lastly, we can use this Nipa account to track the economic condition throughout the business cycle. So we talk about the business cycle. Essentially, it's a fluctuation of the economic behavior, economic performance, right? So we can use that to keep track of the business cycle. Here, I want to emphasize. So this Nipa account is an accounting system for national economy, right? So this is similar but quite different from accounting system we use to keep track of a business, right? So that's the difference. Okay. So before I explain to you how Nipa account works, so we need to do some housekeeping. We need to learn some concepts, okay, so that we can understand how the Nipa account works. Okay. First, we have this consumer spending, right? So what is consumer spending? Essentially, it's household spending on goods and service, right? Who is considered as households? So households include you, include me, right? So this is consumer spending. Secondly, the concept is called stock. What is stock? Stock is a share in the ownership of a company held by a shareholder. To say, for example, you bought 1 share of Tesla, or you bought 1 share of Apple, right? And then you become the shareholder, and you own a fraction of that company. Okay? And then that certificate or that piece of paper is called stock. Now, next one is called a bond. Bond essentially is borrowing in the form of IOU. So here, IOU, IOU, right? That pays interest. So bond essentially is a loan, right? It's a loan in the form of IOU, right? And in reality, so this bond typically refers to corporate bond or government bond. If it is a corporate bond, meaning the company borrows from households. If it is a government bond, means the government borrows from households. Right? So they both borrow in the form of an IOU, and that's going to pay you certain interest. Okay. Now, next we go to government transfer. So government transfer is payments by the government to individuals. But this government transfer has no goods or services provided in return. To understand the government transfer, let's give you another example. The government pay to contractors who build highway system or who renovate a federal building. Okay, in both, and compared to a government give the unemployed person some money. So in both cases, there's a payment by the government. But in the first case, the government pay money to the contractor. As a return, the contractor must repair the highway, must repair the federal government, right? Or in other words, so there are goods or service provided. In the second case, the government pay money to unemployed, but as a return, no goods or service is provided. If there's no goods or service provided, and then it's called government transfer. It's one way. The government transfer money to the households. But in the other case, the government pay the private party to do certain job for the government. Okay, so that's different. Just make sure you understand the difference. Now we go to the next one, is called disposable income. So this income you earn, like for example, the paycheck you receive from your employer, plus government transfer, minus taxes. Okay, let me just write that. So essentially your paycheck plus transfer from the government minus taxes. Okay. Transfer, essentially the payment by the government with no goods and service is provided in return. Example I just gave you is unemployment insurance benefit. Other example, think about tax credit. During the pandemic, right? So in April, the government passed CARES Act, right? So this CARES Act offer any legal citizen $1,000. So that's considered transfer, right? And tax, so essential tax, so income tax, property tax, consumption tax. Okay? So your paycheck and then plus transfer net tax, this is what we call disposable. So here disposable means so you are free to spend the money you have. This is your net income, right? Now we are ready to use a circular flow diagram to understand how macroeconomy interact with each other and how macroeconomy is organized so that we can keep track of economic activity so that we can measure in the size of the economy. Our starting point, you can think about our starting point as a simple model. So this is a model to understand our complicated macroeconomy. Remind yourself what is a model. So earlier we talked about, or we defined model as a simplified representation of real-world situation. And similarly here, so we use simplified representation to capture our real economy. And then so we find out, so the easiest way or the simplest way to capture our real economy is characterize everybody into either households or firms. All right, and households and firms, they interact in two markets. One is a market for goods and service. The other is a market for factor. What is factor? Essentially capital, land, labor, right? So those are factors we need to produce goods and service. Okay? And who is considered as households? So that's pretty much everybody in the economy, like human being, so essentially, right? And what is considered as firm? So firm essentially is just business entity, right? Either it's local business or national or international. Okay, so those are firms. So they produce goods and services, use factors including capital, land, and labor. Okay? And households, they earn some money. Okay, they earn the money to purchase goods and services. Right? So you can see this simple way can capture all the economic activity you can think about, or what was happening every day, right? So you have households and firm. And then please pay attention here. So we made a few assumptions. Okay, one. So this is a closed economy. Okay, so far. Okay, so that's where we start. And secondly, no government. So we start. All right. Okay, so just keep these two in mind. But later, so we are going to introduce open economy, or we allow the economy to trade with others, and we allow government, right? So, but we start with simple. Okay. Now let's focus on this simple economy. So how people is going to interact with each other, or how the economy is organized. Households, they are going to spend their money. How they're going to spend? They are going to purchase goods and service in the market for goods and service. You can think about this as households. They are going to go to grocery store. They are going to buy a house. They are going to buy a new car. They are going to take a vacation. All right? Okay, so this is a starting point. But where does these goods and service coming from? It comes from what the firm produced, right? Okay, and then so here, so you can see all the things you consume coming from what we produce. But what we produce essentially is give you a measure of GDP. All right? Okay, so now let's see what's next. Okay, so firm, they sell their goods and service to consumer, right? So they have revenue. So that is represented by here. So everything, or the value, the market value of GDP essentially is going to show up as revenue for firms, revenue. Okay? But a firm must pay wages, profit, interest, rent. To whom? To whoever the firms either rent or hire or purchase those factors. Right, let's go one by one. Wage essentially is the payment to labor, right? So this factor market. Interest essentially is the cost of using capital. This is another factor. Rent is the cost of using the land or building. Okay, so one more factor. And then finally, profit. Okay, so revenue minus wage minus interest minus rent. So you may have some profit. Okay, but this profit will belong to someone, because this firm essentially is a business entity, right? So it must owned by somebody or owned by the households. But this profit is considered as ownership, right, to the households. Okay? Now, lastly, so all those income or payment by the firm will go to someone, right? And this someone is exactly households. Okay, so now we have a closed loop. So let me erase everything. You have a better picture. Okay, so this is in a closed economy, right? There are households and firms. They interact each other in two markets: goods market and a factor market. Right? Households, they have income. Where does income coming from? Coming from the production happens in the firm. Remember, households, They own the firm, right? And here, so this household, just think about the economy-wise, all sorts of houses, all different kind of households. They own all the business in the economy. So toward the end, all the income or all the things produced by the business eventually must owned by households that show up as income. So this just big things goes income. Okay. And then so households with income, they are going to spend, right? So they're going to purchase goods and service in this simple model because this closed economy, right? So this is spending. Okay, but or you can purchase, or you can spend. Coming from where? Coming from all the things you produced, right? So this is your product. But this product, as you're going to see later, that's exactly the definition of GDP. Now, given these three big arrows I just drew, right? So the product must equal to spending because all things you can buy in the market must equal to what you produce. Okay, so this is the first equality. So spending equal to product. Now, so how are you going to spend? So must come from your income, right? And so that's going to give you another equality. So these two equalities are going to show you. So you either look at product. Oh, sorry. You either look at product, or you look at spending, or you look at income. They are going to give you the same measure of the economic activity in the economy, right? So this is just a simple starting point, right? So you have households, you have firm. So far, there's no government, no international trade, no saving, because essentially you spend single penny you earn, right? So here, so you spend everything. Okay. Now we want to make the model more realistic to capture those possibilities we just assumed away, right? So where we start? First, we consider government, right? So what does government do? So government collect tax from households. Okay? What else does the government do? The government may provide you with some transfer. Think about unemployment benefit. Think about child care credit, right? Or think about Social Security. Think about Medicare, right? So Social Security is a transfer to senior citizen. Medicare is a transfer to elderly for their health care or for disabled individuals for their health care costs. Right. Okay, what else the government do? So the government use their money, so essentially tax minus transfer. That's their net income. They are going to use their income to purchase goods and service. And what is considered as government purchase of goods and service? Think about the government decide to renovate the highway system. Think about the government decide to build new university. Or the government decide to have a new airport. Right? Okay. So now we have a government, right? So besides the consumer spends, okay, as you see. And here, so now we have government also is going to spend. That means when we look at spending, you should include both consumer spending and government spending all together. right? Because the goods and service we produced in business and put on sale in the market will be purchased by households and the government, right? Okay. Now we keep going. So sometimes the households may save, or sometimes the government, their tax cannot cover their spending, right? So here, so the government has tax, and then they have transfer and spending. If your tax revenue is less than transfer plus spending, meaning you are running a deficit. Okay, so that just means you don't have enough money to pay for your spending. And that's what you can do. So we need to consider financial market. The government is going to borrow in the financial market, right? So this government borrowing. And government borrowing through a bond, as we saw earlier, right? So in the form of I own you, right? But where does money coming from in the financial market? Coming from private saving. So essentially, it's a deposit, right? Okay, so here, so you have financial market. That's going to connect savers. This here is household savers. And with borrowers, right? Here is government, right? But actually, not only how a government borrow. So the firm, they may also borrow, right? And so why they want to borrow? So they're going to do some investment, right? So how they're going to do the investment? Essentially, they are going to purchase goods and service in this market. Now we have C, we have G. And so if the firm also joins this market, so you have I, meaning everything was produced by the business. Okay, so those things will be consumed by consumer, government, and some firm itself. How we understand that? And this is just say, oh, so Dell, they assemble, they produce lots of computers. Okay, when we start our discussion, all those computers will be purchased by households. But now, so you can think about, oh, so Dell, they produce some computers. Some of the computer will purchased by business, so for example, you will know, right? And you will know is going to purchase computers. So those computers we will consider as investment for you will know, right? And then so here, so households save, they put the money in the financial market. So the deposit in the financial market, think about in the bank, part will be borrowed by government, and the part will be borrowed by business, so you know, right? So now we add government, and furthermore we add financial market. Okay, so now we are going to make it further complicated. Now let me erase everything. We add the loss element, okay, so which is the rest of the world. Think about Mexico, Canada. Okay. What does the rest of the world interact with us? So the rest of the world may also purchase goods and services were produced. Now look at the goods we produce, or look at spending. So we start with consumer, they're going to spend, they're purchase. And then next we have government. And now we just talk about investment, right? And finally, we have export, EX. Right? So there are 4 sources of purchases that will exhaust the things we produced inside here. But the rest of the world not only purchase goods from us, it could be the case we also purchase goods and service from the rest of the world. So this is called an import. Right? Okay, so and then this may not equal to each other. Import and export may not equal each other. Say, for example, we export less than import. Okay, meaning we spend more than we earn. Right? So we briefly talked about that in previous chapter. If that's the case, so how we can afford the additional import? And then that just means, so we are going to borrow in the financial market as a country. On the other hand, if export is larger than import, meaning we earn more than we spend in international market. Okay, so that's we are going to put the additional saving in the financial market, right? So this is going to show up either as a borrowing or lending. Okay, so now we finish the big picture, right? So we erase everything so you have a sense, right? So where we start from households. Maybe we can just replay what we just discussed. Okay, so we start simple, right? So we have households interact with firm. Okay, so this is a closed loop. So this is spending. This is production, and this is income. This way, this is income. This is spending. So this is production. The 3 ways to look at, or the 3 ways to keep track of the economic activity. Okay. Now, next we introduce government, right? And then so we next introduce financial market. Finally, we have rest of the world. We have import and export. So that close the discussion. So that's essentially explain to you how we're supposed to keep track of economic activity inside the economy. Right. Okay, so as usual, so I'm going to take a 5 minutes break.